We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Smith, founder and CIO of Crescat Capital. How are you today, Kevin?
Good. Thanks, Tom. Glad to be here.
Excellent to have you back. I know it's been a little while since you and I spoke last, but you recently gave a presentation down in Miami at a conference there, and I was hoping we could kind of go through it today. So there's some interesting slides that you guys have, so we can get started with that here. Perfect. All right. So why don't we start by having you explain a little bit by, walking us through the two real problems that investors face right now, Kevin.
Okay. Well, one of the charts that you guys have probably seen a lot from Crescat is this commodities to equities ratio. And it really illustrates the extreme that we have today in terms of valuations of financial assets relative to valuations of commodities. And really the problem that we see is that the two major problems is, one, how do we prevent from getting sucked into financial asset bubbles that are ready that are ripe to implode? Not unlike the tech bubble in 2000, not unlike the Nifty 50 stock bubble in 1972. And at the same time, how do we protect capital in a rising inflation environment? So obviously, there's a clue right here with the commodities to equities ratio. And really this chart here illustrates what some of the risk is really when it comes to the record multiples that we have in the stock market today. This is looking at a 5-year CAPE ratio, a cyclically adjusted PE ratio, the Robert Shiller type methodology, and it's showing that we have record valuations for stocks at large in the S&P 500, and it compares it to other time periods in that table below, where you can see where there's the 1929 peak, the 37 peak, the tech bubble in 2000. These are the subsequent returns that you see in the S&P 500 every time that you have CAPE ratios. And this is actually looking at CAPE ratio in inverted, so it's the earnings yield instead of the PE multiple, but it's making the same point. When you have record low earnings yields, you have the risk of stock market returns that are going to disappoint in the subsequent years. We think we're entering that environment right now.
Kevin, you guys recently published a chart as well. I'm not sure if it's in here next or not, about how the returns in the S&P is very seemingly correlated to the CPI. So is that an interesting indicator and chart to look at as well?
Well, it's interesting. A lot of people think that investing in stocks are a way to hedge against inflation, and it's not true. Not the stock market at large. There's a very narrow segment of stocks. It's resource-oriented stocks, energy stocks, commodity-oriented stocks that tend to outperform in inflationary environments. So if we look at the 2 decades that had the highest inflation in the U.S., it was actually the decades of the 1910s and the 1970s, where median CPI for the whole decade averaged over 6% in both of those decades. And when you look at the average returns to the stock market over those time periods, it was less than 1% for the full decade for the S&P 500 or the Dow Jones in this case, which goes back into the 1910s. And so really after inflation, real returns in the stock market, real returns were negative. And so maybe your question was leading to something else, but it really made me think of this chart here. Mm-hmm. So when we look at valuations, and this is just kind of following on that Shiller earnings yield, CAPE yield chart, if these next 2 charts here are really going to compare valuations for the market at large between the tech bubble and today. And I kind of think we're in tech bubble 2.0 land today. But this is showing valuations in 2000, and it's doing it by looking at the top 5 market cap stocks in the S&P 500 in 2000. And 3 of them were tech stocks: Cisco, Microsoft, and Intel. 2 of them were not: General Electric and ExxonMobil. But collectively, the top 5 stocks represented 24% of GDP. So 24% of the economy in valuation terms represented by the top 5 stocks. Fast forward to today, and we look at the top 5 stocks on the next chart, and it really shows, they're all 5 of them. They're tech stocks. These are the FANG stocks, but it's really the FAM stocks because it's Microsoft, not Netflix. And actually, more recently, Tesla has replaced Facebook in the top 5. But this was in August of 2021 when we did this chart, and the top 5 stocks represented 37% of the total economy, and that of GDP, and that was 54% higher than the top 5 stocks at the peak of the tech bubble. So valuations, recently, today, still, even though the mega cap tech stocks have started to pull back a little bit this year, 54% higher than they were at the peak of the tech bubble. This is just illustrating the risk in the stock market today due to valuations.
So as you point out, Kevin, in the last couple of weeks, we've seen some very dramatic moves in some of the big tech names like Meta or Facebook dropping nearly 27% in the past 5 days. Amazon having that sharp drop, then a real up day. Does this volatility in these massive names speak to the concentration of capital and trend following nature of some of the speculators that own these names?
No doubt. When the momentum, the index funds that own these stocks, the retail investors, we've been conditioned that these are the only type of companies that you can own, and not unlike the tech bubble in 2000 when you get to the end of a cycle, and it usually occurs with a big earnings push, and people extrapolate those earnings trends into the future, into the far future. And in the tech bubble, it was the Y2K phenomenon, and everyone had to upgrade their computer equipment, or it was going to blow up, because the computers were going to roll over to the year 2000, and the software wasn't set to work for that. It was it turned out to be a boondoggle for the tech industry, and it coincided with a peak in earnings. I think the COVID situation, is a similar setup today. Spending has been accelerated. Companies have had to move to the cloud in a much faster way to support remote workers, and et cetera. And the spending, at the same time as we've had all, the huge fiscal spending and the $5 trillion of money printing, it has accelerated the demand side of the equation. Earnings, and margins, everything is as good as it gets. And when it's as good as it gets, and people extrapolate the valuation multiples on top of that, and the earnings growth on top of that, it's just not sustainable. Those are the things that market tops. You've seen Facebook disappoint. You've seen, even Amazon disappointed, with their earnings recently. People didn't realize it because they looked at the abnormal, line item that was included in total GAAP earnings, which was the $11.8 billion unrealized gain on the Rivian shares, that stake that Amazon took in the IPO last quarter. Got booked it flowed through the income statement. And so on the surface, it appeared that Amazon had this big earnings beat, when in reality, their operating earnings were down 50%. And they warned even for Q1 that earnings were going to be, soft again. They guided down for Q1 for all of the operating businesses of Amazon. That includes AWS. That includes the online, the third party, Amazon Prime. Everything. And yet, because of this one-time gain from a stock that doesn't even sell any cars or have any revenues yet. And Rivian, that IPO'd at over $100 billion market cap, it truly was an abnormal gain. And interestingly, also, Amazon started buying back stock recently, even as Jeff Bezos is selling his stock for the first time in 10 years. As the stock started to fall recently, Amazon's been buying back shares. So I don't know what's going on. It's a little crazy, but it just reeks of tech bubble 2.0.
Mm-hmm. I think one of the, let's say, interesting pieces of that you brought up as well, Kevin, it kind of ties into something you wrote in your Twitter header, and that's that wage price spirals aren't transitory. So could you explain what you mean by that a little bit more?
Absolutely. So the inflationary pressures that we have in the economy today are real, and they're real in a way that we haven't seen really since the 1970s. And in the 1970s was a time that the wage price spiral idea became popularized, because that's what was happening. We were in a wage price spiral, and so as prices for goods and services rise, wages need to keep up with that. And these are not short-term transitory phenomenon. There's a couple of structural reasons why we think inflation is going to be around for much longer at a much higher rate. And the wage price spiral is one of them. The other major one is just the rising cost of basic resources and the massive underinvestment that we've had in producing basic resources, talking energy, base metals, and agricultural products, forest products, the basic things that we need for the necessities of life, to eat, to heat our homes, to drive our cars. These things, have been underinvested in now for, in some cases, multiple years. Like the precious metals cycle has really been a 10-year period of underinvestment. The oil and gas cycle, multiple years now of underinvestment in producing oil and gas. So there's a structural aspect of rising inflation on the supply side that the Fed tightening, credit, tightening interest rates can do nothing about. I mean, tighten credit. You think we're going to be able to produce more oil and gas by tightening credit? No. All it's going to do is hurt the demand side of the equation in terms of fighting inflation. But as people, have to start paying more to drive their cars, to heat their homes, to eat, and afford the basic necessities of life, they're going to, they're going to be squeezed. They're going to be demanding more higher wages at the same time as we have what is still right now, record low unemployment. The workers are going to be able to get those higher wages, and this wage price spiral dynamic is something that just feeds on itself. It's not a transitory phenomenon.
Kevin, you bring up something that you and I kind of touched on before we hit record here this morning, and that's really looking at what happens or how the economy and stock market is affected when the Fed raises rates. So should we really be looking at, the 70s with that high inflation backdrop to be able to make a proper comparison, rather than the last couple of rate hikes that we could look at, let's say even over the past 15 years, to make a real comparison?
I think that the vast majority of people that are managing money today, I mean, the boomers, remember it, but have no idea what a true inflationary environment really can be like. We've been fortunate to be, to have gone through 4 decades of declining inflation and declining interest rates. But if we look back to the period of the 70s, we can see what happens when you get in a wage price spiral, when you get in a rising commodity price environment driven by structural supply shortages. This was a time frame, maybe you can show that chart at 1973, 74, where the S&P 500 declined by 50% at the same time as gold stocks went up fivefold. Similarly, oil prices tripled in the same 2 years. And if you look at the Nifty 50 popular growth stocks of the time, the Procter & Gamble's, the Coca-Colas, the IBMs, the Polaroids, they were down over 70% in just this 2-year period. And valuations were, in 1972, at the start of that growth stock, mega cap growth stock decline of its time, we're nothing compared to what valuations are starting from today. And yet we have the same structural supply shortages. Then it was the Arab oil embargo, and oil prices tripled. Nixon abandoned the gold standard, and gold stock prices went up fivefold in just 2 years. You can say, well, we're not on a gold standard today, but gold has really been through a up until 2015, it had been through a 5-year bear market, but we really retested those 2015 lows in 2018. And so, and now gold's been through another 18-month kind of a pullback here. So, gold is cheap today. Well, what are we doing about it at Crescat? We decided to build an activist portfolio. We launched an activist hedge fund in precious metals, where we want to focus on the exploration side of the industry, where we can buy gold in the ground literally for 1 to 2 pennies on the dollar in some of the highest grade gold deposits on the planet. And so you say, well, gold is not as cheap as it was in 72 when we abandoned the gold standard. Well, it really is pretty cheap today, because we're in a financial asset bubble, and we're in a commodity, really the early stages of a new commodity bull market. But like that very first chart that we showed, illustrated the difference between commodities and equities, the commodity to equity ratio, the valuation of financial assets relative to the valuation of commodity assets is the most stretched it's ever been. And that's exactly the same environment that we were in 1972, coming into this period here when gold stocks went up fivefold at the same time as the S&P 500 went down 50%, and mega cap growth stocks went down 70% plus in just 2 years.
Mm-hmm. Yeah, the chart that we're looking at, Kevin, is really dramatic, and it really illustrates that when this capital rotation comes into gold, how dramatic it can be. Like we see the Barron's Gold Mining Index, growing by a multiple of 5, while the S&P is falling dramatically. But it makes me wonder if we could see that same type of dramatic move this time, or if you think there are too many other asset categories that could take some of that capital away from gold.
Well, like in the 70s, it wasn't just gold that went up, and we're bullish on a number of different commodities and commodity equity, segments of the market today. But energy, oil and gas in particular, forest products, we like agricultural products, fertilizer. I mean, there's a number of different ways to play it, but it's a narrow door. The door to financial asset implosion in overvalued fixed income securities and overvalued equities, especially growth stock equities and mega cap tech stocks, is that the capital that's in all of those companies, the index funds that are overweighted in those securities, is extraordinary compared to the valuation of commodities and commodity segments of the stock market. And so we call it the Great Rotation, this period that we think we're heading into. And the Great Rotation is really the idea of investors rotating out of overvalued what we call long duration financial assets. That's growth stocks and long-term fixed income securities, and into undervalued inflation hedge assets. And the amount of money, the trillions of dollars invested in the one category versus the valuation and the other is just a huge disparity. So it's a huge opportunity. And we think it's a reflexive phenomenon in that it feeds on itself because, inflation is really the catalyst for the bursting of this overvalued bubble in long duration financial assets. At the same time, it's opportunity to outperform, rising consumer prices, rising cost of driving your car, heating your home, eating food. And so it really becomes a stampede almost out of one and into the other. And that's what you saw in 73, 74.
Mm-hmm. So, Kevin, if you could walk us through this chart here, showing the length of the U.S. business cycles and what it means in these different inflationary periods, if you could.
So we've studied the low inflation and high inflation periods, and what we found is that business cycles are actually much shorter in rising inflation environments, and I think millennials have been fortunate really to be around, to have been born and lived and managed money through what has been some of the longest business cycles ever. That from 1981. I think millennials were born in the 1980s initially, through like the mid 90s, but from 81 to 2020, the average length of the business cycle has been about 10 years, the longest business cycles in history. But if we look back to the period of the 70s through 1969 to 1981. The business cycle only averaged 5 years. Why? Because that was a rising inflation environment. And when the Fed is having to raise interest rates to fight inflation, it precipitates more downturns in the financial markets, which, obviously when you also have rising inflation in the economy, it's bad news for the economy. So you have more recessions. And I think this COVID recession that we had here shows up as a very narrow line when it comes to shaded recessions. I think because it really only lasted about 2 months. And so if you look at where we are, we really are still, in terms of the valuation of financial assets, it's almost like that recession never really happened at all. And it's really the longest, if you assume it never happened at all, it's really the longest expansion and the biggest financial asset bubbles that we've ever had. So the point being, if the Fed truly is in a new tightening cycle, and they obviously are, there's five rate hikes priced into the curve for the next 12 months. This is we believe that we could be heading into a downturn in the economy sooner rather than later. Mm-hmm. And this next chart here, similarly shows what's already starting to happen now that the Fed has signaled that it's going to be raising interest rates. What's happening? High yield credit spreads are starting to blow out, and you might look at this chart and say, well, defaults are still really low, and it's only 3.4%. What's the big deal? But look at every time that high yield credit spreads. This is the junk bond yield on the bar cap U.S. high yield index relative to the 10-year yield. Look at every time that these spreads have started to widen out from record lows. What does it precipitate? It precipitates financial crises, whether it was the global financial crisis in 2008, the European debt crisis, the U.S. dollar is the world reserve currency. It did precipitate even the European debt crisis in 2012. It precipitated, a lot of people don't realize, but in 2015, we actually had a global recession driven by emerging markets. China, Brazil, and many other emerging markets went into a tailspin. And this was the same time as oil prices were plunging and commodity prices plunged. But it was also precipitated by rising credit spreads. And what happened in late 2018, as the Fed was trying to tighten, and the stock market started to fall apart, we had the Powell pivot, And so rising credit spreads were reversed by Powell, by the Fed, printing more money. And of course, we had the repo crisis at that time, and it was the excuse to print more money and for Powell to pivot. And then you can see in the COVID recession how much credit spreads blew out, but Powell pivoted, and so did the Treasury, and we printed some $4 or $5 trillion since that time. So the COVID recession was brief. But here we are again, coming off of record low credit spreads, record high valuations. This time, our argument is that Powell cannot pivot because inflation is real. And the Fed has to maintain some sense of credibility. So, inflation is the catalyst for the bursting of these financial asset bubbles. It's a catalyst for the Great Rotation, and it's a reflexive type of a phenomenon where rising inflation, causes people to move money out of these overvalued financial assets that are losing money under negative real interest rates and into commodity inflation hedge assets. And the Fed is trapped. The Fed has never been more trapped than it is today. And so this period, like the 1973-74 that we showed, is what we believe we're heading into. It's an opportunity. It's an opportunity for investors to get positioned correctly in a hedge strategy. It's an opportunity to be short those overvalued financial assets, like in our global macro and our long short hedge fund. And it's an opportunity to be long the commodity-related inflation hedge assets, like our precious metals fund, or like the long themes that we have in global macro and long short. What an incredible! I've never been more excited about the opportunity to make money on both the long and the short side of the market than I am today. It's just an incredible setup.
Mm-hmm. Kevin, I'd like to kind of go back to what you're saying about the Fed being absolutely trapped. Do you think that if we get a 30, let's say, just for as an example, a 30+% correction in the stock market, that Powell does try to pivot before ultimately absolutely getting crushed by inflation?
Well, this is what everyone is trying to speculate on, and I think many people are speculating that even though it's not what's in the curve right now in terms of what's being priced into the fixed income markets, mm-hmm. I think many people are speculating that the Fed is going to have to back away from raising interest rates as soon as the market starts to fall. The stock market, that is, or credit spreads start to widen, but when a pivot by the Fed can do absolutely nothing to stop, rising energy prices, rising prices for base metals and agricultural products. I mean, inflation would only continue to rage. Now, a lot of people think this is going to be the catalyst for gold to really go nuts to the upside, is when the Fed has to pivot. We take a little bit of a different view. We think that the Fed is going to have to maintain its credibility, is going to have to hike rates, and it is going to be willing to let the stock market, come down. But at the same time, that's not going to stop inflation, mm-hmm. because of these structural supply problems that we've talked about, and so it's really a setup for both sides of the market, the long commodity trade, including long gold, and the declining long duration asset financial bubble short side of things to work at the same time. A lot of people don't think it's possible because they don't look back far enough in time to understand what a real supply driven commodity led inflation shock is all about. But that's where we think we're headed, and Fed doesn't have to stop raising rates. You look at what happened in the 70s. 10-year yields went up, throughout the 1970s. Short-term rates went up throughout the 1970s, and gold just continued to rage higher. And so it doesn't take the Powell having to pivot again to get gold going, we think that's the next phase of this market.
Mm-hmm. Kevin, as we think about, you mentioned some of the, let's say, the fundamentals for inflation continuing higher, but on the other side, how we think about CPI being reported, do you see a lag in some of the big components of CPI, like, for example, owner's equivalent rent, and how can that affect CPI going forward here as well?
So when we look at CPI, I think one of the biggest components of it, almost 40% is tied to rent and owner's equivalent rent. Mm-hmm. And these things appear in the CPI with a lag, especially owner's equivalent rent. And so when you look at the risk for CPI to go higher just from that component alone, it's already baked in that owner's equivalent rent will be rising, and it's a huge chunk of the CPI. Commodity prices, similarly, we've already seen a big rise in oil, for instance, and natural gas is starting to rise too. And a lot of people may say, well, there's a base effect there, that it's going to be difficult for some of the commodities to continue to raise it, to go up at that pace. But when you look at the structural underinvestment in oil and gas, I mean, oil was $150 a barrel back in mid 2008. It's how long has it been since then? It's like 14 years. No, it's more than that. I can't even do the math in my head. So it's it's 14, 15 years ago. So do you think oil's going to $150 a barrel again soon? I think it's going to surprise people and be breaking out above those levels. I mean, yeah, inflation has already moved higher inside the CPI, but we think there's a lot of risk that it continues to move higher. Meanwhile, look at the 10-year break-even inflation rates embedded in the TIPS yield, on treasuries, and it's only like 2% and change that people think inflation is going to be over the next 10 years. So there's a huge divergence between the current level of inflation, the likely continued higher level of inflation, and what's baked into long-term inflation expectations. A lot of room for long-term inflation expectations to move higher here. So this chart here really illustrates the underinvestment in basic resources in the economy today. So this is looking at all of the commodity producing companies in both the US and Canadian stock markets and their aggregate CAPEX relative to the CAPEX that's gone into the IT industry. IT industry CAPEX is on the left-hand side of the chart. The aggregation of all the commodity CAPEX on the right-hand side. Look at how commodity investment in producing basic resources. This is oil and gas. This is base metals, precious metals. This is agricultural commodities, forest products. Every commodity that you can think of. Look at how it's been in a downward trend, since 2014. And so this is a structural reason why commodity prices are going to be going higher, especially as demand is ramping up now on the heels of all the fiscal stimulus and hopefully coming out of COVID now in terms of a global economic recovery. We just don't, people talk about the supply chain issues. They're transitory and they're going to be worked out. Well, at the core of the supply chain is what? It's basic commodities, it's basic resources. And we just have not been investing enough in them to be able to produce them. ESG policies are partly to blame. The sentiment towards the oil and gas sector of the economy is just brutal. Are we going to have a new green economy? I mean, sure, we need to reduce our carbon, output, and I care about the climate, but people need to eat too, and people need to heat their homes. And to produce, and for everything that we need to move to electric vehicles and solar and wind, you need basic resources for all of that stuff too. We have been under investing in them. Prices are going to be going up across the board look at, and so at the same time, we've had all this investment in technology. All the money's gone to technology. That's great. We need that too. But how are we going to get the basic resources, the copper, the silver, the other minerals that we need to make batteries, the silver for solar panels, that you need energy to produce fertilizer, to make food. Imagine what's going to happen when fertilizer prices start going up and farmers, can't afford to plant crops because natural gas prices are rising and food prices start rising. So this is a setup. It's really the underinvestment in basic resources as we have overinvested in technology. Again, just a perfect chart to illustrate the great rotation idea, selling overvalued tech stocks, buying undervalued commodity producers, and why we're doing that today. Here it's showing similar the CAPEX cycle for the precious metals miners, and you can see that this peaked out really in 2011, 2012 was when the CAPEX in the precious metals industry last peaked. And look, it's been in like a 10-year bear market. So 10 years of underinvestment in producing gold and silver. At the same time, gold is ready to break out to a new all-time high. And look at how this pattern normally works. I mean, yes, we will see more investment in producing precious metals. It's coming. The cycle is only just starting to turn, but the underinvestment that we've seen over multiple years is the setup. It's the bullish fundamental setup on the supply side for a new secular bull market in precious metals, and it's still very early in the cycle.
Kevin, would a possible reason for this underinvestment at the current gold prices be the inability to get out in the field and spend some money on exploration because of COVID? That's something that I've heard that has been pointed to that could kind of explain this?
Well, certainly in some parts of the world, it's been difficult to mine, and that's been a constraint. But there is somewhat of a renaissance in exploration going on, and I like to think that Crescat has been a big part of that. We said that we've seen this cycle setting up for some time. The record debt in the world today, and the need to inflate our way out of that debt through inflationary policies, negative real interest rates. We think it's been the setup for gold prices to go higher for some time. But it's been frustrating to see gold just kind of waffle along here. Well, it did start to perk up in late 2018, 2019, and 2020. We've had this pullback for the last 18 months or so that's been frustrating. But what we really decided to do when we talk about Crescat getting activists on gold is we wanted to really get money to the industry to do the drilling, to do the exploration, to make the big new discoveries. And so when you look at the CAPEX cycle for gold, it really has more to do with building the mines. But that's where the big CAPEX actually comes in. And the exploration side of it is actually, it's still capital intensive. I mean, it takes money to do drilling, but it takes about 1/10, in some cases 1/20th the amount of money to go out and do the drilling to make a new discovery than it does to actually turn it into a mine. Well, the majors, the Newmonts, the Barricks of the world have underinvested in both, and they've completely abdicated. In other words, in both the drilling and the CAPEX of building new mines. But they've abdicated the exploration to the juniors. And so, for us, that's where the real opportunity is in the junior exploration side. We've funded over 80 companies in the last 2 years, have put to work something like $100 million that we have actually put into 80 plus different companies where we've gotten the money to these companies to do the drilling. So I like to think that there is money going into exploration today, but that we're at the forefront of it here at Crescat, thanks to our association with Quentin Henney, who is one of the leading exploration geologists on the planet, probably discovered more gold than any other geologist out there. And he's come to work for Crescat full time now, starting middle of last year, and is a key part of our investment team in putting this money to work. And so we're able to. While the majors are not doing the exploration, and neither of the mid-tier companies, our junior companies that we've helped to fund are doing that work. They have been able to explore during COVID. It's been slow. There's been a lot of delays. There's been a lot of delays in the labs and getting results, but there is exploration activity going on. We have over 300 million target gold equivalent ounces in our portfolio among these 80 plus different companies that we have. And we're on to some exciting new discoveries. So stay tuned. I think things are going to be changing. This chart here shows the number of gold discoveries greater than 2 million ounces. This was through 2020 the last 4 years up until very recently, we have seen no major new gold discoveries. It's because of that lack of investment throughout the industry. The majors and the mid-tiers not investing. At the same time, the juniors haven't been starved for capital. We think that is all changing now. And again, we're at the forefront, and we have a number of companies in our portfolio that are onto some major discoveries, including some major copper discoveries, some major silver discoveries, and major 2 million plus gold discoveries. Now, an interesting note about this chart is that this is companies that have published resources of greater than 2 million ounces, and nowadays it's almost the kiss of death to actually come out with a resource too soon, and so you kind of want to sandbag, if you will, and before actually publishing that resource. So we have a number of companies in our portfolio. You guys are familiar with one of them, certainly, that Palisades is a big owner of. That's on to much more, to one of these $2 million plus discoveries, but they haven't published the resource yet. But there's going to be a lot of them coming here soon.
Mm-hmm. This kind of speaks to the falling grade and discoveries overall, right, Kevin?
Well, absolutely. When you look at all that CAPEX, the CAPEX cycle for gold and silver on the prior chart that showed it peaking in 2012, back then, look at how the industry was spending like drunken sailors, 2010, 2011, and at the same time as the gold price was peaking out back then. And a lot of money was invested in producing gold, but it was not, a lot of the projects that were funded, tended to be very low-grade discoveries, and a number of these companies and deposits are still out there today. And a lot of people, will look at some of these companies and say, and I'm not going to name any names, but there's a lot of resource out there that was created that's low-grade resource. It might be big deposits, but it's going to take much higher gold and silver prices to make those deposits profitable. And some of them will never become mines because they're just not high enough grade, or they're not in the right jurisdiction. So what we're really trying to do in our partnership with Quentin Henney is get the money to the companies to make the big new high grade discoveries in the best jurisdictions. So being much more disciplined, and that's one result of this starved capital environment for the precious metals industry, is that the money is going to the best projects, and so just being much more disciplined about how we allocate capital to the new high grade discoveries, and those are the ones that will become mines. Those are the companies that will be bought out by the majors. Grade is just extremely important.
Mm-hmm. All right, Kevin, that's kind of the end of our slideshow there. Is there anything else that you'd like to bring up before we do wrap up here?
Well, thanks, Tom, for the opportunity to speak with you. And if anyone is interested in learning more about what we do at Crescat, I encourage you to go to our website at crescat.net. And we have a lot of materials up there on the website about all of our different strategies. There's contact information for Merrick and Cassie, our client services representatives who can answer any questions. Feel free to reach out to them via email or to call them, and really appreciate this opportunity.
Great to speak with you again, Kevin. And of course, you're available on Twitter at Crescat Kevin. Kevin, thanks so much for your time today.
All right. Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.